Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Marc Hedin, and I'm Aura's Head of Research for UK and Ireland power markets. I'm delighted to be joined on the show today by Robert Todd, Managing Director at CIBC Capital Markets in London, providing M&A advisory support to global clients across the energy transition. Rob has a distinguished career of over 25 years in investment in the energy sector. Rob, welcome to Energy Unplugged. Delighted you joined us.
Hi, Mark. Thank you very much.
Today, we will be discussing long-duration energy storage, or LDES, as this space is gathering momentum with a growing recognition of the role of long-duration storage to support the energy transition. And multiple regions are currently deploying support schemes targeting LDES, like the UK, Ireland, Australia, Italy, the US, Spain, and many others. So one question, Rob, before we jump into the topic of long-duration energy storage specifically. You've had an impressive career in investment banking for over 20 years across borders with a focus on the energy space. So I'm quite curious, how would you say the investment landscape for clean energy has changed in the past 20 years?
Well, I've been fortunate to experience several chapters in clean energy. The industry has evolved at pace, which has been both stimulating and challenging along the way. After a foundation in London with a broader energy and utilities background, I decided to try something new, moved to Hong Kong in 2006 and focus on renewable energy. At this time, clean energy in Asia was focused on more industrial capabilities. The massive downstream installations that we see today arrive later on. So therefore, the day-to-day work with clients really was much more involved with the likes of solar panel OEMs, polysilicon, wind turbine OEMs, plus other components like solar glass, turbine blades, and transmission systems. This was also an active period for outbound investment, strategic policy initiatives such as China's One Belt, One Road, which led to a diverse range of partnerships across the world. A transformational boost, though, was the introduction of feed-in tariffs for downstream renewables projects across the Asia-Pacific region. This led to working on all sorts of transactions like the first-time non-recourse financings for renewables in India, in China, plus a wave of issuance of public bond issues, plus new listings and IPOs. Interestingly, though, the emphasis then shifted to more inbound investment into Asia-Pacific to take advantage of this new growth path. So international strategics and financial investors began establishing their offices within the region, targeting platforms at scale from India up to Japan, down to Australia, New Zealand, and all countries in between. Flash forward to today and the growing initiatives to drive a deeper decarbonization of the global economy beyond renewables and electrons. We spend, I would say, around half of our time on wider transition technologies. Like today, we're talking about long duration, also battery storage, green fuels like hydrogen and its derivatives, SMR nuclear, etc. So it really makes it a fascinating time to be in the energy industry today.
Fascinating career. Would you say that investing in energy is becoming more globalized? And does this give CIBC in particular an advantage in this respect?
Well, I'd say our day-to-day experiences tell us that it's crucial to bring a global perspective to offer best advice with clients. Our clients are seeking partnerships, both strategic, but also capital-based to support their growth at ever-increasing scale into broader markets. So maybe as an illustration, we recently worked on a transaction involving the creation of a new renewables investment management platform backed by leadership in the UK. The project acquisitions were in North America, and the equity funding actually came from Australia and New Zealand. So you can see in practice that these are natural drivers for us to build out our CIBC capabilities in London to complement the other offices we have globally.
So a good place to start to discuss long-duration energy storage is to recap what we mean by long-duration energy storage and why it's needed. For the benefits of our listeners, I would say that LDES is defined as technologies that are able to respond to supply and demand variations caused by daily peaks, weather events, and seasonal patterns, and providing energy for over 4 hours at full capacity. Although, good to note that there is no one single definition for how long is long. We think of it as new technologies quite often, but we need to recognize that there is already a significant amount of LDES deployed across the world, mainly in the form of pumped storage hydro, with about 140 gigawatt of installed capacity. Other technologies are a lot more nascent, and for them, the challenge, in my opinion, is to get them to scale, and we'll address that in a minute. But we are already seeing some development in this space. In GB, for instance, we've recently seen 9-volt batteries pre-qualifying for the upcoming capacity market auction. We're also starting to see developers securing offtake agreements, such as a 320 megawatt compressed air energy storage in the Netherlands. So we say that things are getting some tractions, but it is early days. In terms of needs, to take the example of GB, where we're both based, if we do a sort of like quick market sizing exercise and ask what is the scale of imbalance in a net zero grid available for storage to address, then we estimate that in this net zero world, we could see as much as 46 gigawatt of storage capacity needed by 2035. And if we take that storage estimate and ask how much of that has to be over 4 hours duration, so corresponding to LDES, we are looking at approximately 24 gigawatt of capacity needed by 2035. That being said, Rob, there's kind of an elephant in the room here, right? In a world where we have a successful deployment of lithium-ion short-duration batteries and already got plenty of gas peakers, is there economic room for LDES, and how can LDES compete with these two?
Well, as you highlight, Mark, there are some impressive growth projections around the broader energy storage space. It actually reminds me of an anecdote. You can think of the energy storage market as an athletics meeting where you have multiple events. So whilst there's a range of storage technologies across chemical, thermal, mechanical, etc., some will be better suited to quick response applications, so like sprinters, and others to longer duration applications, like a marathon. So in practice, I think it's unlikely that a single technology can cater to all these different applications at best system cost. Today, though, the lithium-ion technology does dominate. The bulk of value is in shorter duration applications, whilst there is an unwillingness to attribute value to long duration storage given the lack of applications at this point. So this has really proved to be a barrier to the commercialization of long duration technologies so far. However, the long duration technologies themselves can enable larger scale projects to meet some of those vast numbers that you mentioned. Plus, though, importantly, the potential to deliver lower costs than the lithium-ion technology. Finally, whilst gas peaking is proven and relatively less expensive to build, it can be a premium cost to operate, as we've seen with some of the volatile gas prices over recent years. But overall, these factors contribute to the cost of energy of the transition itself, and of course, the impact on consumer bills.
Absolutely. And I believe it's also that we're approaching the use case of LDES in the same way that we're thinking of batteries at the moment. But there could be some new applications for LDES specifically linked to the production of hydrogen, for instance, that could bring additional value, right?
Yes, absolutely. I think the focus of discussions around long duration today is on grid firming, managing intermittent and seasonal power generation, but also the deferment of transmission and distribution infrastructure upgrades. However, the next chapter of growth could also well be aligned with the production of green molecules like hydrogen and its various derivatives. The magnitude of green fuels targeted around the world translates into significant new renewables capacity, which far exceeds what we have installed today. Plus, to deliver these production volumes on a consistent basis aligned with offtake arrangements leads to the integration of energy storage, which requires a longer duration. We're actually seeing this dynamic on live assignments we have in the hydrogen space at the moment, where there are key conversations around, firstly, the optimal strategy to procure the qualified renewable power. This actually may not necessarily need to be fully fixed price PPAs, but also critically the technology selection for the integration of the storage capabilities into the overall complex.
Mm-hmm. You've mentioned earlier a couple of projects that you have worked on in your career. Can you share some details on LDES projects specifically that you've been involved in? What were the main challenges that you've encountered, and what were the key takeaways?
Yes, sure. We previously supported Hydrostore, with their equity raise to secure a new partner. And it raised a couple of interesting takeaways to highlight as follows. I think, firstly, there was a big debate amongst the Hydrostore management as part of the raise to think, are we a technology provider or are we a project developer? Actually, in the end, after a lot of conversations, the answer was both, in the short term at least, because in-house project development was really necessary to help accumulate some track record. Whereas in the longer term, to accelerate the capacity growth and the broader expansion of the technology, it's really more about building close relationships with the project developers themselves who can then help deploy your technology. So this dynamic really informed the design of the capital raise, thinking about holdco versus asset co related raises, but also particularly important when it's combined with the achievement of key project milestones, recognizing the early stage nature of the platform. So that was a key subject. Another one also was really about who are the addressable investors willing to join the platform at an early stage and support this journey or bridge to commercialization. Recognizing that pre-FID capital is tougher to find. Whilst there's no shortage of investors keen to learn about the technology, everyone's intrigued to learn more about emerging technologies. But this really represents an early stage. It's almost considered as sort of venture type funding, but at infrastructure scale. And I think that dynamic often limits the appetite. So it places more of an importance on filtering the investors who have broader investment remits, but also importantly, seasoned investment approval channels, I would say, for new technologies becomes even more important. So coming back to today, since closing their partnership with Goldman Sachs Asset Management, Hydrostore has progressed really well. They've actually signed multiple offtakes, including in Australia and the US, to support their project developments. And I think plenty more to come.
Super interesting. Just one question on that. Like, in this instance, what would an offtake agreement look like? Is this for a standalone long-duration energy storage asset, for instance?
That's right. So on this occasion, it's directed towards the project itself, not a broader portfolio. Actually, it's long duration and long tenor, so 25 years, 8 hours of storage, and 200 megawatts. So quite a benchmark to achieve, I'd say.
And Hydrostore is developing a compressed air energy storage solution, if I'm correct. I think it's important to recognize that the concept of LDES is actually a patchwork of different technologies, right? Some more nascent than others, and each with their own characteristics. I think, broadly speaking, they can be clustered in sort of like 4 categories: mechanical, thermal, electrochemical, and power to gas. Do we need all these options? Or can't we just meet system needs just with lithium ion or pumped hydro, for instance?
Well, we talked earlier about the athletics analogy and that different technologies may be best suited for different applications. I think in the same spirit, though, you can pair these technologies. They're not mutually exclusive. And this can then help focus on addressing different markets, which are then suited to their characteristics locally. So, for example, in the Hydrostore situation, you can pair the likes of compressed air technology together with lithium batteries in order to provide services to both the shorter markets and the longer duration markets to satisfy the needs locally. So I think in the future, we'll certainly see a mix. The open question is, what will that mix of those technologies look like?
So, yeah, and based on what you just said, not all technologies can be deployed everywhere due to geographical constraints, but also system needs. From your experience, where are the sort of best opportunities to develop LDES? What are the best addressable markets, and what makes a great market?
So far, we've seen markets like the US, particularly California, and more recently New York. We've seen New South Wales and Australia. We've also in China seen leadership around long duration procurements. And these have resulted in new projects and even offtakes now being secured locally. We're starting to see the long duration topic being examined in much more detail by other regions as well. Most recently, you've seen in the UK an announcement of an industry consultation to explore cap and floor structure for long duration storage. And recently, there's also been an interesting report in Canada, actually proposing 6 gigawatts of long duration capacity to support Ontario's journey to net zero goals. And this is beyond their existing activities in battery storage, and acknowledges some of the challenges around long procurement times more generally, but also the expiry of the existing 30% ITC in 2033. So I think the topic is being raised in more markets, which helps. Up to date, it's been concentrated in just a few.
Yeah, and I would probably add that when governments say they want to develop LDES to reach their net zero goal, there's also one key aspect to LDES is that as an asset class, they can help make the most of the current infrastructure. In many regions across the world, like California, you mentioned, New York, GB, Ireland, grid is now the limiting factor to further renewable deployment, and LDES can alleviate some of those constraints. So I'd say it's important to note that LDES should probably not be considered a full replacement for transmission capacity build out. To take a sort of like local example in GB, for instance, if that was the case, we would always be left with LDES technologies in the north of the UK perpetually charged and unable to dispatch due to tight transmission capacities with the south of the UK. So we've compared LDES to batteries several times already. Probably another place where it's useful to compare them is how different is the approach to commercialization. Do you see specific issues that need to be addressed to support the route to commercialization of LDES from an investor's perspective, especially for the more nascent technologies? How does that route to commercialization journey look like? How do you get to scale?
Well, the tricky dynamic is how to prove out the technical aspects of your technology, build in-field track records so that you can show prospective partners, developers, banks for project finance, whilst also being disciplined with your capital needs and, frankly, avoid prematurely diluting your shareholders in the process. So thinking back to the Hydrostore example, the company has used conventional components, which are bankable in their own right. And so therefore, the focus really more comes around the integration of these different technologies at scale, utility scale, plus adopting a revenue model to ensure the project is sustainable going forward. So the conundrum for the developer is the importance of having a pilot or demonstration project is very important, albeit at a modest scale. And that allows real-time due diligence, in-field track record to be undertaken, and really shows you that the technologies can work together on an integrated basis, secure offtake. At the same time, though, the developer needs to think about and how to articulate that pathway of how you go from that smaller scale demonstration pilot type facility up to a utility scale, and what are the issues that need to be addressed to convince all those different stakeholders.
And thinking about those early demonstration projects that you just mentioned, how do they raise equity? I'm asking that because I often hear that in the energy sector, it's easier to deploy 500 million rather than 50 million pounds, for instance, because most investors are big institutional investors like large pension funds. So for them, it can be too much effort and too little reward to deploy a small amount of capital. How does this work for nascent technologies like LDES technologies, for instance, where there's a need to first invest in smaller scale projects before getting to scale? And who's investing?
Well, capital raising for new ideas and earlier stage technologies is certainly a more challenging exercise. It's akin to venture investment into infrastructure, which I think we mentioned before, which also means, in energy terms, it's capital intensive. So it's a question of whether who has the appropriate risk appetite to partner at scale. Is it more about the strategic players? Perhaps they can contribute some synergies like procurement, offtakes, etc. Or is it about financial players who have genuine development risk appetite to bring? And then beyond that, we're actually seeing the emergence of a number of new funds, particularly specialists around energy transition, whose investment remits are being designed to address these emerging technologies and differing business models. But overall, I would say that the pre-FID type platforms and projects are more troublesome from a capital raising perspective. There's a more limited addressable universe of investors, more challenging for investment committees, I think. However, the list grows substantially when you consider post-FID situations. And that's, to me, has been quite a defining moment when I think back on different processes that we've been involved in.
And so once the technology is at scale and needs to think about raising debt for larger projects with a long-term view, how do investors approach financing technologies which will operate in markets that don't really exist yet? I mean, there's currently like a lot of uncertainty around the future market design in many regions. As we mentioned earlier, all the regions that are currently thinking about LDES deployments are sort of toying with their market design. And there is a bigger question around the value recognition of the services that LDES can provide that is sometimes currently missing.
Lenders are naturally cautious around nascent technologies, particularly when you consider limited or non-recourse style structures, which inherently have longer tenor horizons. The developers, though, are conscious from the very outset of designing their projects to be fit for bankability purposes, including the use of conventional components, which we mentioned before. So as projects advance along the development pathway, it's important to consider multiple sources of potential funding, including development institutional funding, grant funding, export credit agencies, commercial banks, institutions to meet their overall funding needs. There's enthusiasm from the lenders that we found to support the growth of these new markets and technologies, which is consistent with their own climate ambitions. But this tends to be a progressive approach involving both the structuring teams, the credit risk teams, and really prefer to see clear support from policy frameworks, some of the track record aspects that we mentioned before, whilst also adopting some more conservative terms to begin with, so like debt sizing relative to established segments. And in this regard, the offshore wind industry is often used as a comparable where there was a similar dynamic when this technology first came to be. The project financings were really focused on the operating projects after, say, 1 or 2 years of operating track record. And it took some time before the first greenfield offshore project finance was completed. However, today, of course, there are multi-billion project finance syndicates for offshore wind projects, and this has become more the norm. So hopefully we'll see the same in years to come in the long duration space.
So clearly, when we mention bankability, policy support seems to be like the key item. In the UK, the government has launched a consultation on the LDES, suggesting that a revenue cap and floor mechanism would be the way forward to support LDES. For the benefit of our listeners, a revenue cap and floor regime means essentially that a project will secure a minimum gross margin, the floor, that will allow it to raise debt, while allowing some upside that is attractive to raise equity up to a cap, beyond which excess revenue is partly clawed back by the government, hence limiting any negative impact to consumer cost. Is this a solution to help support LDES? Are there areas that are left out with such a mechanism?
Well, this is a helpful start for the technology, Mark, and the government will be focusing on the amount of long duration needed, as well as a number of parameters outlined in the report. Whilst the revenue cap and floor is likely a good mechanism, there is a risk of over procuring or under procuring, in the same way we saw the AR5 round for offshore wind more recently, due to some ill-determined parameters. This long duration deployment will also need to be aligned with broader enhancements around renewables build-out, grid enhancements, to really avoid a system that overpays subsidies. With the framework, though, there's a couple of topics that need further thinking, including the deliverability of aspects of long duration. So, for example, the lengthy planning is highlighted, but also the consultation seems to exclude the lithium-ion technology. So perhaps they can consider having a technology agnostic framework. So there's a level of playing field there for all parties.
Absolutely. Your point about the risk of over procuring or under procuring is really interesting, because it shows how difficult it is to get a market design right And we often forget that underpinning big ideas, there are countless parameters that governments or regulators need to get right. Otherwise, there's a risk of creating some distortion with sometimes material consequences. You mentioned the allocation round 5 last year in the UK, which failed to procure any offshore wind and put in peril the government targets for offshore wind by 2030. All this in a large part because the administrative strike price, which is effectively a cap on strike prices that project can bid in the auction, was too low and did not reflect recent capex inflation. So this is an interesting space to watch as we said, many regions are considering implementing some form of support mechanism for LDES, and getting the details right will be critical to their success. Maybe one final question, Rob. Taking a more global view, 2024 is said to be the biggest election year in history, as about 2 billion people around the world, in the US, in the UK, India, South Africa, and many other nations, are set to elect new administrations. In your opinion, for the pace of the energy transition in general, is the impact of those elections overrated or underrated?
Off the back of a tough fundraising market backdrop last year in 2023, we are seeing green shoots this year into 2024. So there's reasons to be optimistic, I would say, for the outlook this year, notably the trajectory of easing interest and inflation rates, the recent performance of the capital markets, and seemingly greater willingness for limited partners to commit funding, so they're not uninvested for a prolonged period. On the industry side, we are seeing improvements in offtake pricing. So the latest OREC solicitations for offshore in the US, the AR6 announcement in the UK, and these will help realize new project developments, plus some renewed policy support, which I think will act as positive catalysts. Actually, last week, I was in the US and we had a gathering with clients, and amongst all things, the election clearly and the prospects for IRA were highlighted. This is a complex area. There's a lot of topics moving around, with the election itself, of course, taking place later in the year. But it's worth noting that it's a comprehensive piece of legislation, but it's not alone. There's a number of other pieces of legislation like the CHIPS Act, etc., for reshoring of manufacturing, and all of these elements I think will come into play. And particularly the impact will be broadly felt across all the states, and their initiatives can also be both at a federal or a state level, just to add more complexity to the picture. But overall, we're optimistic around the prospects for continued investment around energy transition and growing levels of investment.
This has been a fascinating discussion, Rob. We barely covered the tip of the iceberg, I think, but it was still extremely useful. I'm very intrigued to see how things unfold in the next decade for LDES. Long duration energy storage feels like the sort of next frontier for the power sector on the road to 24/7 clean grids. And we're at a tipping point, it seems, with what I understand from you is increasing appetite from investors, but also policy support that is coming together, and so much technological innovation.
Well, thank you, Marc. I really appreciate the invitation and much look forward to seeing you and everybody at the Spring Forum in March. I think specifically for long duration, there are good reasons to be positive. We see the growing policy support that we've talked about in new markets. The technologies themselves are advancing at pace, and hopefully we're starting to see tangible examples of offtakes as well being secured at the project level. So this year, I'm confident that we'll see long duration platforms coming to the market, raising incremental funding, equity, and debt to really help support their paths towards commercialization, and in the process establishing some quite exciting new benchmarks for this emerging technology. So yeah, thank you very much.
That was Marc Hedin, Aurora's Head of Research for UK and Ireland Power Markets, speaking to Robert Todd, Managing Director at CIBC Capital Markets. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.